Whether you succeed or fail may very well rest on whether you're tenacious enough to push through incredible hardship and refuse to fail multiple times. Almost every great success story has inside of it a story of near-death experience as a company. And if you decide to give up, well, you're done.
Welcome to another amazing episode of the Tech Business Roundtable podcast, brought to you by Equa.tech, the leader in digital marketing for tech companies. We want to first take a moment to thank you for sharing this podcast with your friends and on social media and helping us grow week after week. Meet our host of today's TBR episode, Ryan Davies. Ryan is the Director of Marketing of Equa.tech and is a dynamic leader in driving business transformation through technology. Over to you, Ryan.
Welcome, everyone, to the Tech Business Roundtable podcast show. This is a podcast show dedicated to shining a spotlight on tech innovators, entrepreneurs, founders, and the compelling narratives behind the movements they've established. I'm your host, Ryan Davies, and I'm hosting today's discussion, Venture Chronicles, a Founder's Odyssey into the Heart of Tech Capital, with Ben Narasin. Ben, thank you so much for joining us here today.
Hey, thanks for having me. It's always good to do these.
You know what? I can't wait to dive in. The amount of expertise, knowledge, and just life lessons here, I think our listeners are going to be invaluable for our listeners. Ben Narasin, known for his involvement in the tech and venture capital industry, has been an active investor and entrepreneur with a focus on early stage startups. He's been known for making investments in these early stage tech companies and is a serial entrepreneur as well, and been involved in building and scaling and exiting a number of amazing successful companies along the way. He's an advisor and a mentor, providing guidance and support to emerging entrepreneurs, and is a polished public speaker known to participate in many industry conferences, sharing insights and experiences with the broader community. 25 years experience in business, 17 as a VC. I want to turn over to you in case there's anything I missed there to color up the rest of the way, Ben. But
that pretty much covered it, man. It's like my LinkedIn profile is 25 years as an entrepreneur, 17 years as an investor. I guess it's 18 now. But yeah, they both feed the other. I mean, being an entrepreneur was critical to my ability to sort of shape how I think about being an investor. And there are not a lot of us. I used to believe there would be a lot of ex-founders as VCs, but it's a relatively small slice of the venture community.
I think that's amazing. You know, I'm a big sports guy, and it's always some of the best managers are the ones that are ex-players, or coaches are best ex-players, right? Because you've lived both sides of the journey, so you kind of get a unique perspective from that side of things. And you've had a diverse but incredibly successful career as both a serial entrepreneur before transitioning into the venture capital world. Can you walk us through some of the key milestones or lessons from the entrepreneurial journey then that helped shape your perspective as an investor?
Sure. I mean, I can sort of sum up 25 years in 30 seconds. I got my first job when I was 11, working for 25 cents an hour in credit. I then got a raise 25 cents an hour in credit, 25 cents in cash. I thought that was a big deal until they paid the same wage to the next guy. So that was, I learned a lot of managerial lessons from what a bad boss I had obviously the guy's employing an 11-year-old. Come on, that's not a good start. Started my first business when I was 12. Ran businesses for pretty much nonstop thereafter. It was the only thing I ever, like my whole life when I was young, I only cared about basically dating and entrepreneurship. And now I only care about my family and entrepreneurship. So unlike you, I don't have any interest in sports, nor do I have any hobbies. Other than my founders and my family, the only other thing I do is play Call of Duty at night and sometimes on the weekends, usually with one of my founders out of Latin America. So, along the way, what really gave me there's two things about my entrepreneurial journey that have been particularly valuable to me. One was all the realities you learn by being an entrepreneur. This is not a thing you learn to do by reading. I mean, there are lessons to be learned in books. I have plenty of books. I've read many, but where you're really going to learn is by doing. So a lot of people have a false perception about what entrepreneurship looks like, and I have none. There's no naivete in me about how hard it is. It's the hardest job in the world if you're not a first responder. If you're in an office, it's the hardest job in the world. The other thing that happened was I started one of the first .coms in 93. So I was there for the birth of the web and all the technology that was built to support it. And that entire run up and crash down. And then when the bubble burst, I had taken that company public. but I had never raised venture capital, so I was able to take it private. But I also bought about a dozen other startups that had raised enormous amounts of money. I made money on 11 of them. I made a mistake on the 12th. Every mistake I made and everything I did right has been valuable for me to help other entrepreneurs on their journey. But that company also gave me the liquidity and freedom to do whatever I wanted. I actually retired for quite a while. I don't need to ever do that again. I failed that entirely. If I think about the failures of my life, retiring is one of them. So, when I got to Silicon Valley about 20 years ago, I saw this big gap in the market between angel and venture, and that's what I decided to fill. So in 2007, I started what was one of the first 3 institutional seed funds, it turned out. So basically, I've been doing seed since 2007. I also did traditional venture investing. So during my 17, 18 years as an investor, it was 8 years as a seed investor, 7 years in traditional venture, mainly at NEA, New Enterprise Associates, which has historically been the largest venture firm in the world and one of my favorites. And then I spun out of NEA about 2.5 years ago with their support to start my own fund, which is seed and occasionally pre-seed. And so I'm looking for entrepreneurs that, I'll tell you a quick story. When I first started doing investing, when I was doing just seed predominantly, I was 3 years into the journey and I had not had a single company fail. Now I was backing about 8 to 10 companies a year. That really worried me. I was like, I am clearly not taking enough risk. Because 2007, 8, 9, I'm backing guys and gals with PowerPoint slides and nothing else. I should have had more failures. Nope. So I decided to loosen up on some things. That was a mistake. It changed my view of investing dramatically. I tightened all that stuff up. I realized there's other places I can loosen up, but really only one. But I was talking to a friend of mine who I've known for a long, long time. He actually worked for my father, and we almost did a business together when I was young. And I was saying, I'm very confused. I don't understand how I can have no fails. Like, I clearly am making a mistake here. You can't do this early a stage investing and not have people fail. Now, believe me, over the last 17 years, my failure rate's about 1/3 of my companies, which is lower than venture, which is about 40%, but it's not zero. I don't want it to be zero. Zero is wrong. But he looked at me and said, oh, I get it. I was like, what do you mean you get it? I don't understand it. I'm me. He's like, yeah, no, that's it. You only invest in people just like you. I was like, I don't understand. What do you mean? He's like, you will never give up. And you back people just like that. If you think about the name of my fund, Tenacity Venture Capital, tenacity is the only secret to entrepreneurial success. Brilliance is assumed. I'm not funding dumb people. Sorry. A great idea is assumed. I'm not funding dumb ideas. And a huge market is assumed. If you have those three, without those 3 things, I'm not going to fund you. The difference between whether you succeed or fail may very well rest on whether you're tenacious enough to push through incredible hardship and refuse to fail multiple times. Almost every great success story has inside of it a story of near-death experience as a company. And if you decide to give up, well, you're done.
That's just incredible. I love that. I love that story of the no failure rate, and then realizing that even no failure is a failure in some essence, right? To be able to embrace that and not go out and celebrate it and have that expectation that, well, I'm bulletproof, I'm fail proof in this sense.
That's the most dangerous thing there is. Once you get overconfident, man, like, I think you should always be nervous. As a buddy of mine who's been successful as an early stage investor showed me a company that I had a lot of experience in. He basically showed me a company that was almost identical to a company I'd started during the bubble. And I told him it wasn't going to work and I didn't want to invest. And he looked at me and he said, Ben, my track record is unparalleled. And I was like, are you saying because you haven't had a failure in your portfolio before, you won't in the future? Yeah. Like, that you're such a good picker that you're not going to make a mistake? And he didn't. He was like, well, I said, you know what kind of rock climbers die the most? It isn't amateurs. It's experts. Yep. It's overconfident experts that didn't wear a helmet. And I can tell you exact stories of this. And that is a dangerous place to be. I saw that investor's company again about 2 years later, raising money. And it was the same story. And I was like, yeah, I'm a pass. How's it going? Well, we burned through $10, $12 million and it doesn't look like we're going to make it. Not a surprise. In fact, I had given the entrepreneur some advice to do something totally different that he was always succeeding at. And he said to me, I should have listened to you about that other thing. Hey, if you want to put 10 million in a crater and light a match, that's your business, but it ain't going to be my money. Hey, look, people burn money up all the time. Some of my entrepreneurs spend way too much, but you gotta have a shot. And I don't think these guys had a shot.
I mean, I love the real world stories and kind of that putting it into perspective from that sense. And you kind of talked about, calculating risk and risk, mitigating risk and things like that. And I think you've probably got a really unique balance of the instincts of an entrepreneur with that ability to be analytical from a VC side. But, how do you evaluate risk as a VC? And, what advice would you give to founders about, like you said, embrace risk while still maintaining kind of that strategic prudence and being cautious in what they're doing?
So those are two really big questions. So let's break them into two. Let's talk about my
Perfect.
evaluation of risk first, then we can come back to entrepreneurs' bearing of risk.
Love it.
So, I often will say, I have all these pithy little sayings, and I've stolen lots of other pithy little sayings from other VCs. I always say I need 5 things to make an investment. People, 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 a great idea and a huge market if it works. So what I realized the first time I thought I wasn't taking enough risk is that I needed to be willing to take more risk, and I decided to take that risk on the people. That was a mistake. You never compromise on the people. Now, I also don't want to really compromise on the idea or the size of market. What I realized was I would be so obsessive in my diligence that one material risk factor could get me to not do a deal. And one of my favorite phrases I've stolen from somebody else, and unfortunately I don't know who to credit with it, is, we will underwrite to 1 miracle, not 2. And what I realized is if everything else checked a box for me, but there was one major risk, that was a tolerable risk for me to take. And I learned this because I was working on a company. There was a woman that pitched me in a demo day session, and I loved what she was doing. And it was in a category I didn't know well. So I spent a whole bunch of time on diligence. In the end, I came back and said, I'm really, really worried about fraud risk for this one specific reason. And because of that, I just don't think I can afford to take the risk, because that one thing, if it happens, kills your whole company. She was raising money at that time at $3 million pre or post. This was, 2008 when people did that. About 9 months later, we talked again, and she is absolutely crushing it. And I'm like, I made a mistake. I really want to invest. Can I invest? Well, not in the last round, but if you help me raise my Series A, I'll let you invest in the Series A. So I introduced her to an investor who funded her for the Series A. That's a big part of what I do, a tier 1 firm here in Silicon Valley. And I invested alongside of them. And I paid 30. Now, the pricing is irrelevant. What's relevant is I paid 10 times as much as I would have paid if I was willing to bear that one risk. So what I realized is when it boils down to one risk, I can be wrong 8 times out of 10 and be better off. So I don't need to be that obsessive. And I've tried to get better. By the way, it's a constant journey. This is not a destination I've reached. This is a journey I continuously travel. I was reading about Charlie Munger, who just died recently, and I just ordered his book, and which is being republished because it was out of print and thousands of dollars, and I'm not paying thousands of dollars for a book. Maybe there's so much wisdom in it I should have. But he basically said one of his favorite things was to tear down his long-held beliefs. I love that. You have to be willing to be wrong. Now, in fairness, my wife will often basically say to me, because I frustrate her all the time. I've been married for 30 years, by the way. Why are you always right? Why are you so sure you're always right? You're so confident in this. Why do you know you're right? And I'm like, honey, I am not always right. But if I look at my history, I am usually right. So all I can do is, there's a saying, another saying I stole from somebody, seldom wrong, never in doubt. It is often hard to question your beliefs. There are things I think won't change about me, and I've sort of tried to be self-aware enough to know those. I talk too much, as an example. Tried to work on that. It never works. I've given up. It's not that because I'm older, I'm stuck in my ways, but I think there are genetically brain-coded parts of me that I don't care how much I train aren't going to change. But a belief system should be able to change. Data should be able to change it. Like, it is another great quote I stole from somebody. Actually, Mike Maples stole it from somebody, quoted it to me, told me who it came from. I don't remember. If we've got data on this discussion, we need to look at that.
Yeah.
If we've got opinion, we'll go with mine. Opinion is your gut. It's your subconscious. It's everything you've learned in your entire life.
Yeah.
And if it comes from an informed place, it's important. If we're going to debate something in startup land, I'm comfortable with my opinions. If we're going to debate something in physics, I'm not. If we're going to debate chemistry, I'm not. Real estate, I'm not. You win every single time. Your opinion, better than mine. You want to talk about the ruble? I got nothing. So, you can beat me on that one easily. But if there's data available to support an argument, that's what I want to see. And if it shows me that I'm wrong, great. Prove me wrong, no problem. I will admit I'm wrong faster than anybody. I just need the proof or a very compelling argument to show me that you've got more knowledge and the ability to show me, at least indications of my wrongness that are helpful to me to understand it. The second part of your question, though, was entrepreneurs' willingness to bear risk. So, and this is also a question, by the way, for aspiring or actual VCs, because it's amazing how many young people that go into venture that don't really understand how to think about risk. It's like somewhat stunning to me. But, the reason I think entrepreneurship is so hard, one of the many reasons, and the reason I have so much respect for entrepreneurs, you've got somebody that had achieved something. Maybe they've got a great job. Maybe they got a great education, whatever. And they're now going to put all that aside and take the ultimate risk financially to try something new. No safety net, nobody to rely on if things go wrong. They're to blame for everything. And they're going to jump, if they do it right, all the way into the deep end of the ocean and start swimming.
Yep.
Now, having said that, one of the things you need to do as an entrepreneur is be willing to jump. Not jumping is a tragic thing. And many examples of this, but you've all heard it. Perfect cannot be the enemy of good enough. Get that thing live, start learning from people that are going to touch it. Don't stay in a room with your peer group and hash out what you think is going to happen. When I started my web business in, call it 93, I spent 6 months on research. I took Unix classes. I talked to people. I learned to code HTML, blah, blah, blah. I learned more in 6 days of being live than in that 6 months. All 6 months was wasted compared to what I learned from people touching my product. Yeah. And I regret that I did. I mean, it all went well. I got the company public, et cetera, et cetera. I'm here because that gave me the liquidity and freedom to do what I wanted to do. But I could have gotten there 6 months earlier. We were one of the first in the world, but I was one of the first 3 institutional seed investors, but Josh Koppelman announced first round capital 1 week before me. 2 weeks earlier, a little harder work. I could actually sit here and tell you I was the first. To my knowledge, the third's a guy that claims he was there then that I never saw, but I'll give him credit for it. That's why I say 3. I don't know, the details of when he actually started. But hard work is critical to this. Hard work is important. Smarts are important, but luck is required. I don't care how smart you are, and I don't care how hard you work. Somewhere along the way, the combination of that hard work and serendipity or some other form of luck, which could just be timing, is the difference.
Yeah. What's the saying? It's the success is where opportunity meets time, or whatever it is there, right?
Usually,
right.
Luck is the combination of hard work and serendipity.
There it is. Yeah, I love
it. The harder
right?
you work, the luckier you get. The more opportunity you have to get lucky.
That's exactly it, right? And I think, we talked about a little bit about it now already, but I think listening to you speak and how you present this, the founder market fit, I think it's a little distinctive in how you do it compared to the traditional way. But maybe you could delve a little bit into the importance of that aspect in terms of how it influences investment decisions and success from that founder market fit perspective.
Well, a lot of my entrepreneurs are first-time founders. They may or may not have experience in the category they're attacking. I'm fine if they do. I'm fine if they don't, if they have a compelling vision. One of the things that, people tell me, ask me, what do you look for? What do you look for? What do you look for? It took me years and years and years to have an answer. My answer is simple. I'm looking for founders that make me say, wow. Now, wow might not be deep expertise in the category. It might be a vision of the category that I've never thought of. Sometimes wow is incredible depth, cogency that's just insane. But, I need to believe in, as I said, people, the founder's critical, but the idea and the market. So, one example I use of a pass for me, which my wife thinks is a mistake, by the way. If you say to me in line 1, because you always have a 1-line elevator pitch, we're making GPS dog collars. Awesome. I've fostered 200 dogs. I need those dog collars. It's not a venture-backed investment for me. I don't see a multi-billion-dollar public company. My definition of venture-backable investment, multi-billion-dollar, probably 5 or bigger public company in the future if everything goes right. There's luck, there's hard work, there's everything. But if it works, it's a $5 billion public company that can grow from there. Preferably, by the way, my favorite business is uncapped upside, no limits. I mean, there are 5 trillion dollar companies, public companies right now, all in the United States, all startups. No reason I should that's the level I would like. My fund, we're shooting for 40 to 100x on an investment, but I would like to have 1,000x, and I'd like to have an unlimited. Look, liking, wanting, this year we were on pace to see about 8,000 pitches. I backed that down about halfway through the year, but we funded 3. I don't fund top 1% entrepreneurs. I fund top 1 BIP. It is a ridiculously hard thing to be a founder and to get to success. And I know that from experience. And look, like I said, 17 years in, 150 companies, a third of them have lost me money in some form. I've got 5 companies that are public at this point in my history, not including my own. I guess that would make it 6. I've got lots of great acquisitions. That wasn't what I was shooting for, but they made me a lot of money. I've got 40x, 58x, 30x, 60x, another 58x, 100x. I don't have my 1000x yet. So you're not going to get 1000x funding the top 1% for the most part, I don't think. Look, de facto, all my entrepreneurs are top 1%, but they're the top 1 BIP of the ones I see. So it's look, venture is not the right form of money for a lot of types of businesses. And that's probably one of the greatest places of misunderstanding for entrepreneurs. So it's like the old saying, why do you rob banks? That's where the money is. People pitch venture because there's money there. That doesn't mean it's your type of money. If you're a vegan, you shouldn't be pitching a steak restaurant, right? Like venture, think of it this way. If you're a lion, you eat meat. You don't try to serve a lion salad or they'll eat you. So that's venture. Like there's a certain type of thing they need. They need to return the fund. You're pitching $1 billion fund, man, you much better have a line of sight to a multi-billion-dollar acquisition or a multi-billion-dollar public company or outcome if it all goes right. Because if you have a line of sight to a $300 million acquisition by Salesforce as a nice tuck-in, that's great for you. And it's probably pretty good for a small fund, but it ain't interesting to a multi-billion-dollar operator.
Yep. I love
so
that.
Avoid the pain of being in conflict with somebody later.
Yeah.
Because by the way, conflict means they veto your deal and fire you and replace you with somebody else.
I think that's just, again, incredible advice in terms of like making sure you're positioning yourself properly, you're aligning properly with the right people, and the expectations are met from both sides on that side. And I think, both entrepreneurship, and you kind of touched on it before, and venture capital require this unbelievable amount of adaptability and being able to react to changing dynamics, especially, in the tech landscape as well. Things are so rapidly moving and whatnot. What advice do you have for kind of founders that are navigating these similar changes in terms of, these ever-changing, environments that they're in?
Someone said it pretty well. It was firm on vision, flexible on path. So I often will say to entrepreneurs, like, you have to have a northern light. How you get there is going to change. If you are rigid in your belief of how to get there and it is a straight line, well, life's going to smack you in the face. Think about, like, I don't like pivots. I don't like it when basically a pivot to me is when you take your crew and you sail off to get to, the island of Series A. Something goes wrong. You turn the boat around, you sail it back to the dock, you unload the crew, and you think about another journey. Not great. Those have very, very, very low success rates.
Yeah.
They're few and they're very famous, but you can count them on one hand. You'll have plenty of fingers left. I don't mind tacking into the wind. Just stick with the metaphor for a second. You're sailing to a point and the wind's changed. You got to tack into that. That's fine. Be reactive, be flexible. I'll give you an example that isn't about how you run your business, but it's the same mindset that can be very damaging to an entrepreneur. Entrepreneurs pitching me from a deck, which, by the way, always pitch from a deck, in my opinion. I spend 4 hours on average when my entrepreneurs are going out to raise their Series A doing what I call deck doctor. A huge part of what I do is help my entrepreneurs raise Series A. Help them with their deck. Help them with the introductions to the right people at the right time. Help them with term sheets. Help them with what they need to expect. So you're pitching an investor and you get to slide 1, you get to slide 2, and you get to slide 3. I have a question. Blah, blah, blah. Back to slide 4. Well, I don't really know if you answered my question. Can we go back to that? And the obvious frustration, usually from an engineer, to be honest, of not being able to go to step 4 and 5 and 6 is like, dude, here's what I say to my founders. If a VC asks you a question in a fundraising, that is a yellow light. You slow down and you answer that question. Now, if it's later in the deck, you can say, hey, I've got a slide later. Do you want me to jump to it? Or can we, come back to it in a few minutes? They usually say, yeah, just come back to it. If they ask you a question a second time, that is a blinking red light. You do not advance until you have thoroughly answered that question and they are comfortable with it, because you might want to get back to your deck. It's not about you. Sales 101. It doesn't matter what you want. It matters what the guy or gal across the table from you wants. And if they want to get that question answered, if you don't answer it, they are not paying attention. They are thinking, why the F didn't this person answer my question? Well, I guess I have to figure it out myself. They're ignoring what you're saying because inside their mind, they're back at that point of confusion. That rigidity of, I have to get back to my deck. I have to follow my process. I have to go from step 1 to step 2 to step 3 to step 4. And I don't care what you want, is enormously frustrating, almost immediately a pass for me, and really crushes your presentation, but it also will crush your business. I don't mind if you plan out the next 100 years. That's great. You want to have a 100-year vision? That's awesome. But if you're so stuck with it that you're driving the Titanic, you see the iceberg and you say, you know what? This is the path we charted. It's the straight path. We got to jam through that iceberg. They all died, right? You know that story. So you move the boat and you get around the iceberg and you figure it out. Be willing to tack into the wind in pursuit of your ultimate goal. Now, if your ultimate goal has been proven to be impossible, rare, or you just have for some reason decided it's not the right goal anymore, that's a different discussion. That's usually how pivots work.
Yeah.
But one of my favorite, again, I steal so many quotes because they're so good. What's the old saying? Good artists borrow, great artists steal. Yeah. It's the best opportunities were until recently impossible and are now merely highly improbable. GAI is probably a great example of that, but there have been many over time. Because when you change the world fundamentally, that's when you make truly enormous businesses that people can just be extremely proud of, are extremely profitable, remunerative, just wow. I mean, we all want to have a Google in us.
Yeah.
As an investor, certainly. And I hope, also that's probably not a fair thing to say. You don't need to have a Google in you. You need to have what you need in you. And this is where I think the biggest challenge for entrepreneurs seeking venture capital can be. There's a huge difference between what you need and what you want. We might all want to be billionaires. I don't know if I care. Would I refuse it? I mean, if nobody knew and somebody came to me and said, I got $1 billion for you and I got it in gold and I want to give it to you because I saw this interview you did on this roundtable and I thought you were awesome and I think you deserve to be a billionaire. I'd be like, obviously there's strings. This is a pretend thing, but I wouldn't say no.
Right.
I don't have anything to do with that money. I'm not that philanthropic yet, which is the only way you can really use that kind of capital unless you're like a over-the-top yacht builder or plane buyer or collector of super exotics. So, hey, it'd be nice, sure. But it's not like I need that. But I will tell you this, when I was running my company and we signed that underwriter's letter, I had somebody come to me that wanted to buy the company from me. I owned 80% of the company and they were going to pay me the low end of the IPO range. And I immediately, without thought, said, absolutely not. Because I needed to take my company public. That was basically the embodiment of everything I believed I would be since I was 12 years old. There wasn't any possibility I was taking that deal. Here's the thing. If I just took out a piece of paper and wrote on one side, sell company of which I own 80% for the IPO price, or take the company public with 50% dilution, and then wait an eternity to sell my shares, which I never did, because you don't get to sell your shares as a CEO of a public company, I would have realized very quickly, that's a lot more money. But that wasn't, in fact, the only board member I liked and trusted, my board was not fun, said to me, Ben, you cannot just say absolutely no to these things. This is life-changing. This is huge. And I said to him, that's not what this is about. My arrogance was outrageous, but it was because it was born from something that I believed I could be and I needed to be.
Yeah.
Most of the great entrepreneurs are arrogant, insane, or irrational. Who says no to hundreds of millions of dollars? Well, you're not going to get a multi-billion-dollar company out of you if you're going to say yes to the $300 million bid. So my point is, it is not about what you want. It is about what you need. What is the thing inside you that when it is provided to you, you will say yes? If you come from, you come from a small town, the wealthiest family in the town has a $2 million house. If you came home having sold your company for $40 million and keeping half of it, $20 million, you would be the biggest thing in town, and that matters to you. And that is what you've always wanted your entire life and what you need. You're going to sell. Someone offers you 40, you're done. Nothing wrong with that. That is, whether it's truly life-changing, it depends on where you live. That's tough. 20 million and then taxes and different conversation. But net, do you have kids? You're in a major metro, you go to private school, like, geez, do you want to have, do you have aspirations in certain ways? But net, if that's what you need, you're going to want to take it. You want investors that are aligned with that. Because if you don't have them, I have seen more than one person, some friends who had the opportunity to take a lot more than that off the table and were shut down by their investors. You take money from a VC or any form of private equity, that's a one-way prenup, and you don't control it. They can divorce you, you cannot divorce them. And you tell them you want to do XYZ and they don't like it, well, maybe you don't get to do XYZ. And I've plenty of stories on that path. So
that's just I mean, incredible. I love these stories. I could talk all day on these, and I love when now we have a guest visitor too as well.
Yeah.
Mine's sleeping in the chair beside me.
I have a story about a cat that cost me $500,000, but I won't tell you that one.
Story for another time. As we're closing off here, I really kind of want to just touch on one more thing here, is sort of like crystal ball looking ahead in terms of areas of trends or innovations, again, around the tech industry, if we've got it, but from an entrepreneurial and an investment perspective, are there things that are catching your attention? Are there things that are, that stand out to you? Or again, is it really just about, are you the right person with the right idea and the right market to make it go?
Yeah, no, I think it's the last. Look, as I said, we were on pace to see 8,000 pitches this year. I funded 3. I got pretty close to a deal this month, but in the end, we couldn't see eye to eye on what rational pricing was. And
yep.
I care about entry price. So I don't look, GAI is interesting. It's going to change a lot, maybe everything. It's not clear to me how you protect it. There's a story I like, which is that in the US, at the peak of the internal combustion engine's early days, there were 200 car companies. Picking a GAI opportunity is like believing that you can pick out which one's Ford. I don't know how to do that. So I'm pretty reticent there, but I'm open-minded. The company I almost invested in was a GAI company. I think he wanted too much of the sizzle valuation of GAI, and I wasn't going to get there. Yep. way too early. No way to be clear it could be protected. I was willing to bet on the entrepreneur at what I thought was a pretty high price, but he needed even higher. So I'm not really a thesis-based guy where I'm like, I'm seeking X. About half my portfolio is fintech. I was just sitting with a VC I know this morning right before this interview, and he's like, you really like lending. I'm like, well, I like lending as long as they've got an edge and as long as it's an ARB. Like, I don't want balance sheet lending, but I think if I've got proprietary underwriting data and a way to make good money on the lending and, there's value beyond just the lending, sure. Not a lot of people in fintech like lending, but it's not that I went out looking for lending businesses. It's that entrepreneurs presented me with really smart opportunities that are enormous, that could be just amazing businesses. And in some places, even make the world a better place, which is a nice bonus. I'm not a double bottom line investor. I'm not a triple bottom line investor, but I believe a good human being, and I'd like to see the world be better. And so I don't have any companies I know of that make the world worse, but I have several that I know make the world better. So that always makes me happy. It makes me happy. It can't influence my decision. You're going to make the world infinitely better, but you're not going to be a viable multi-billion-dollar public company. That's for double bottom line people. Go find a charity. So I don't have anything specific I'm seeking out right now. And the reason for a long time that I would just, 8,000, I mean, it's crazy how many pitches you hear because I'm just looking. It's like this business is literally in many ways, and I have changed my process because I didn't think that was as productive as I was hoping it would be. But, I've always seen at least 1,000 companies a year, even in the old days. And it's sort of like digging through a mountain of granite or garnets, because somewhere in there is that precious diamond. And you don't even notice that it looks different in the beginning. Sometimes you have to stare. Sometimes you see it where one of the facets is shining, it's a diamond. Other times it's like, By the way, if you have to do a lot of squinting, you're probably making a mistake. That's not an investment you should make. If you have to think, yes, but, and well, if, and let me put it this way. I've learned many things in 17 years. If you're talking yourself into something, you've already made a mistake.
Love that. I think it's even beyond investing advice. That's something we could just all take away if you're doing that.
True as an entrepreneur as well. Look, Everything's harder than you think. Acquisitions are a great example. Never going to work out the way you think they are. Cut all your projections in half and you're probably still being optimistic, and then decide if it was worth doing it. But, I believe very much in the importance of trusting your gut. Gut isn't some magical voodoo. Gut, to me, is your subconscious mind expressing what you have learned over the entirety of your life. But going back to this, my gut is only relevant to things that I have some point of reference on. Maybe it's the humans. Maybe it's the idea. Maybe it's the market. I don't know. But if it's about something I don't understand at all, I don't think my gut's worth anything. Should I have a gut like this morning? I had a board meeting that started at 4:30 a.m. because it's UK. And I'm up here and I'm like, about as soon as the market's opened, we're in a part I don't need to listen to. I like Berkshire Hathaway, so I'm going to sell some options on it. I decided to tweak the price. If I just hit boom, I would have made back half the money I sold in 15 minutes because the market moved that way.
No.
I was like, oh, I should have just traded, like as if I had a gut instinct. I would have made all that money in no time. Guess what? It went the other way, and then it was down. Did I have a gut? No, of course I didn't have a gut. There is no such thing. I don't have a magic crystal ball gut that predicts the stock market, but I have a gut for entrepreneurial realities and for people, I think, and that's what I'm going to rely on.
Incredible. You know what? I'd love to just last as we're kind of closing off the episode here. Tenacity Venture Capital is who you're with as the founder and GP there. For our listeners, just to learn more, maybe there's someone who's like, he'd be perfect to speak at our conference or something like that. Just ways to reach out and get more from you.
Oh, sure. Well, there's, so I read 100% of my emails. I read 100% of my LinkedIn inbounds, and I read all my Twitter DMs. So both Ben Narasin and Tenacity have LinkedIn profiles. I don't even have a website. The Tenacity LinkedIn profile is the equivalent of a website. You message me there, I'm going to see it. You DM me on Twitter, I'm going to see it. I read them all. By the way, for entrepreneurs that are interested in pitching me, one thing I'll encourage you to do in any VC you pitch is read their profile. Like, you can also Google me, and I've written for everybody from Business Insider to The Information and TechCrunch. My content's out there big time. The reason I do so many of these, I want people to be able to understand me and decide if I'm relevant to them before they pitch me. Okay, but here's the thing. On my profile page, Ben Narasin, founder and general partner of Tenacity Venture Capital. Boom. Second line, pitch me or send me what you want to talk about in a one-line elevator pitch with ARR if you have it, period. I don't do crypto, security, or medtech. 90% of my inbounds, 7 paragraphs long, crypto opportunity. I now have stopped bothering to react. I just send them back a picture of my profile with the headline circled. Okay. So if you do want to pitch me, here's the other point. I read it all. It doesn't mean I respond to it all. I wake up 500 behind. I'm going to read them all. It doesn't mean I'm going to say, by the way, if I do respond, not a fit, that's all you're going to get, because I'm not going to explain why. I have people that used to send me deal flow and they're like, could you tell me why you didn't like the last 11, but now you want to see this 12? No, and don't send me any more deal flow. I can't sit here and take 583 reasons why I didn't decide to respond to something. But I'm happy to respond to the ones I like, and I'm happy to do a Zoom, and I'm happy to do a meeting if a Zoom works out. And, to me, it's all about in person at this point, but I still do a lot of Zooms.
Perfect. That's incredible. So, I think with that, let's take a minute. Heartfelt thanks from us here and from all our listeners, Ben, on this amazing podcast, Venture Chronicles, a Founder's Odyssey into the heart of tech capital, with Ben Narasin. Ben, thank you so much. The insights, the stories, the wisdom shared here, invaluable, and hoping we can do this again, because I think there's 50 other topics that I'm sure we could cover here.
Always happy to do it. You can always do an AMA and let your entrepreneurs ask questions, but I enjoyed it. Thanks for having me. See you next time.
Wonderful. Thanks so much, Ben. Really appreciate it. And we can't do what we do without you, listeners. So until we meet again with another amazing TBR episode, I'm your host, Ryan Davies. Thanks so much for being here. Take care, everyone.
Thank you, Ryan, for this amazing episode. Thank you for joining us on the Tech Business Roundtable podcast. We hope our discussions have sparked new ideas, expanded your knowledge, and empowered you on your entrepreneurial journey. Don't forget to hit that subscribe button and write us a positive review. Thank you for listening to the Tech Business Roundtable podcast show.